What's up everyone, my name's Robbie, this is Robbie Manila, and today we have yet another amazing video. So in this video, we're going to talk about the ARK Invest ETF. Now ARK is an active fund manager and it's a research company that invests specifically in disruptive companies. ARK was founded by Cathie Wood, who you may have seen on CNBC or other news stations talking about some of the companies that they invest in, companies like Tesla for example. Now ARK gets a lot of press, and rightly so, considering the amazing returns that their ETFs have had. So far in 2020, ARK's ETFs are some of the best performing in the entire market. And what's amazing about ARK is it's not just one ETF, they have multiple ETFs that are killing it. So ARK has different ETFs, but in this video we're going to talk about the ARK Innovation ETF, which is ticker symbol ARKK. So for those new to investing, those who aren't very familiar with ETFs, I want to make sure that you understand what ARK actually is. So when it comes to ETFs, a lot of people are under the impression that they only track an underlying index or a benchmark. And if you don't really understand ETFs versus index funds or mutual funds, I made a video, I'll link it right here, take a look at that. So while ARK is an ETF, it is not an index tracking ETF. For example, maybe you've heard of Vanguard's VOO ETF. That specifically tracks the S&P 500. The ARK ETF is not like VOO, it is actively managed. So ARK has analysts and portfolio managers, and their job is to find the specific stocks that are going to go into their portfolio. So ARK isn't like an index fund that's just trying to track an index, it is an actively managed ETF. So what's interesting about ARK is that it does not compare itself to any benchmark or any index. They don't buy companies just because they're a certain size, and they don't buy companies just because they're in a certain sector. For example, ARK might invest in a small company, a large company, or a giant company, and it might even invest in different industries like biotech or healthcare or information technology. And one reason is because ARK doesn't think that a disruptive technology has to be in a specific sector, a specific industry, or a specific size of company. So to figure out if the ARK ETF is a good investment, if it's something that we should all be adding to our portfolios, I'm going to break this down into 4 different parts. Our first part of the video is going to be an ETF checklist. This is just a checklist of things that I want to see in most ETFs. Next, we'll go through an ETF analysis. In this section, we'll go through things like the holdings and the past performance. In part 3, we're going to talk about the risks of the ETF. And in part 4, we're going to go through my thesis about whether or not I would buy this ETF and why. Okay, intro is over. Let's go ahead and let's get started. Okay everyone, before we begin, I would really appreciate it if you disrupt the like button. Alright, let's go ahead and get started with part 1, the ETF checklist. Okay, so here you have my ETF checklist that I created. This is just a checklist of things I like to see in ETFs, so let's go ahead and go through this. By the way, I'm going to go through this quickly because honestly, I want to be concise in this video. I hate when I have like a 30-minute long video. Let's try to get this between 15 minutes. It would be great if I could do that. Don't know if I'll be able to, but we'll try. So, first thing, gross expense ratio. So, this is how much the fund is going to cost, or the ETF is going to cost. So, 0.75%. So, this is the ARK 0.75%. It's a little high. So, what is ARK's ETF compared to? So, if we compare it to other ETFs that are actually selecting stocks to buy, then maybe it's a little closer to those. But if we're comparing it to a general index tracking ETF, it's a lot more money. So it's a little high, but you know, maybe you pay for what you get. So the ARK is doing a great job. Maybe they can justify their fee at this point. The net expense ratio is the same, so no worries there. Net assets are 8.9 billion. Plenty of assets in the fund, so I have no problems with that. Average volume, the 10-day average volume is 3.6 million, totally fine, no problems there. The net asset value, so the net asset value, if you don't know what that is, it's important. So, for example, let's say this ETF has $1 billion worth of different stocks in the fund. So if you add up all the stocks that they have, it equals $1 billion exactly. Now let's say maybe when you go to purchase the ETF, the price of the ETF reflects having a little bit more than $1 billion. So maybe it's a $1 million dollars. So there might be a little bit of an extra premium that is on the fund. If it's lower than the billion, it would be a discount. So 0.03, it's quite close, so pretty good. The bid-ask spread, so ETFs trade like stocks on the stock exchange, so there's a bid and there's an ask price. So you want to make sure the spread isn't too wide, and the spread is 0.06%, not too bad. There's no tracking error because this does not track any type of index, so we don't have to worry about that. The beta, which is the volatility, is 1.61. This is a quite high volatility, quite high beta in my opinion. So I don't love how volatile it is, but that's the answer to that one. So we keep it in mind. The thing with this spreadsheet is that it's kind of allows me to make a judgment call based on all the different factors. So I take a look at everything here and then I'll kind of decide if it's okay or not okay. So the PE ratio, there was no PE ratio listed for ARK because partly most of the companies that it invests in don't have earnings. So they're very kind of speculative companies that may have great innovation one day, which may one day lead to great earnings. But a lot of the companies don't have any earnings. So there's no way to calculate the PE ratio. The price to book, 7.76. That's a high price to book. So these are kind of more growth-oriented companies for sure. And then the distribution yield is 0.2%. So if you're interested in investing in an ETF to get yield, then to get income, then this is probably not going to be the highest paying income type of ETF. You'd want to look at something that has more yield. Let's try to compare ARK now to two other ETFs to see how it looks. So first we have a momentum ETF, which is MTUM. It invests in specific stocks. So it tries to find stocks that are experiencing momentum and invest in the best of those stocks. And then VOO is just an index tracking ETF. Okay, so MTUM might be more closely related to ARK in that it's a specific stock fund or ETF. They're trying to only invest in specific stocks. VOO, of course, is only investing in the index or the underlying S&P 500 index. How are the expenses? Well, MTUM has a lot lower expense, 0.15% versus ARK, 0.75%. VOO, it just tracks an index, so it's very low, 0.03%. The net expense ratio is 0.15%, so it's the same. The net assets, they're good, so no problem there, 11.7 billion. VOO has a ton of assets, 557 billion in assets. That's a huge fund. Average volume is totally fine. A little lower than ARK for MTUM, higher than ARK for VOO. Premium discount, no problems. Bid ask, no problems. So volatility, this is where we should maybe see some interesting information. So MTUM has lower volatility than the overall market, which is very interesting. I would not have thought that would be the case, but it has a lower beta. Now, the beta of VOO is 1 because it tracks the S&P 500. The PE ratio of MTUM is 32.55, a little higher of a PE, meaning that it's got more growth companies, more growth-oriented companies in it. And then VOO has 25 PE ratio. So next is the price to book. MTUM has quite of a high price to book, a little over 7, just like ARK Invest. Now S&P 500, or VOO via the S&P 500, 3.56. So much lower, about half of the price to book. And then we have the distribution for MTUM is a little higher than ARK, 1.1%. And then if you want a decent yield, you get 1.78 with VOO. So this is the complete kind of picture of this ETF checklist that I like to take a look at. Now, here's something very fascinating that I think we should take a look at. Okay, so when I say fascinating, this is something that I think is very interesting, and I think you will too. Of course, I say I'm going to try to make this video as quick as possible, but I think this is worth it. So take a look at this. We can figure out how much revenue ARK makes if we take the amount of net assets, which is 8.9 billion, and we multiply it by their expense ratio, 0.75%. If we do that, we get about a 66 $1,750,000 in revenue that they're making from this ETF. So hopefully you find that interesting. I find that pretty fascinating. It's interesting to know how much these fund managers can actually make. So let's go ahead to part 2. So if we compare ARK to VOO, the Vanguard ETF, we can see that it returned 82.70%. I mean, that's a great return over this amount of time, but of course, ARK just killed it with a 387% rate of return. So that is amazing. Not rate of return, a 380% total return over that time. So let's change around the time period. Let's say instead of, for this whole time period, what if you had just invested in the first, let's say, few years of the fund until November of 2017, so 2014, 2017. What's the rate of return? So if we look around the first 3 years of the fund since inception, we can see that it really did take off within the first 3 years. So you had a 70-ish% rate of return in the first 3 years of the fund. The S&P 500 did, a good job. So 29%, but through VOO, the Vanguard ETF. Now, if you look back though, you can see that just with around 2.5 years into the fund, it really was not outperforming the S&P 500. So there are going to be times when a fund like this, an ETF like this, is going to underperform. I mean, it can't always have amazing returns. There has to be time periods where it doesn't have amazing returns. So let's take a look at one more thing. So if we take a look at the year of 2019, we can see the returns of the S&P 500 versus ARK, and we can see again, ARK did outperform around 36-37% versus the S&P 500, around 30%. Now, let's quickly say, what if instead of the S&P 500, what if we invested in something that tracks, let's say, information technology? So let's take a look at another fund. So here we see VOO, ARK, and then I added XLK. XLK is an ETF that invests in the IT sector. So XLK actually had a higher return than ARK did. These are all amazing returns, and if you had any of these ETFs, I mean, I'm sure you'd be very happy to have returns like these. Okay, so now we can see some of the different holdings that are in ARK, and so the first thing, of course, we see here is Tesla, and Tesla is their largest holding. It's 11% of their assets. So how did Tesla do over the past year? It's up 484%. So a nice chunk of the gain that they've had in this fund. Part of it is from Tesla. Then we look at NVTA up 170%, SQ up 181%. So there's some great returns in all of these. Zillow Group, 172% rate of return over the past year. So, I mean, if you had invested in this fund or any of these specific stocks, you would have made great money. So let's take a look though and see how risky these stocks are. Okay, here's a comparison of the top 5 holdings of ARK. Now, if you think about it, this is probably maybe around 30% of the entire portfolio. So there's quite a bit of weight in these 5 stocks. So what do they look like? Well, the first one, Tesla, we can see the long-term debt-to-equity ratio is 66.17. So not too much debt. Their return on equity is very low, 4.76. Return on assets is low, 1.78. And then the price to earnings is 851. So yeah, that's a lot. That's a very high price to earnings ratio, meaning the stock is very expensive in terms of earnings, which means people are paying a lot of money for the potential of earnings growth down the road. So next is NVTA. We have a long-term debt to equity, also not too bad, but then we have negative returns on equity and assets, and we have no price to earnings ratio because, again, it doesn't have any type of earnings yet, so it's not profitable yet. Square has a 85 for a debt or a long-term debt to equity. So basically, if we take a look at all of these, they don't have great returns on things like equity and assets yet. They don't have low PE ratios, if they even have a PE ratio, meaning that they're growth stocks that are very maybe expensive. Not expensive as in you shouldn't buy them, just expensive in terms of earnings. You're gonna pay a lot of money for a very small amount of earnings because you think they're going to grow. So anyway, this is a way to kind of understand what this ETF is investing in. If this is your style, if you're okay with that, great. If you want more of a stable ETF that only invests in things like blue chip stocks that are going to have decent PE ratios and aren't going to be very high, or stocks that have nice return on equities and assets, you're probably not going to want to go with this fund. But if you're okay with it because it's had a great return over the past years, then maybe it's going to be for you. So let's take a look at the risks. Okay, so ARK has some different risks associated with it. So the first thing I would say is that you've seen over time that ARK has done well in a lot of periods, but there were periods where it didn't perform that well. And so ARK itself says, if we take a look here, that during risk on markets, ARK does do a great job in performance. So when people are okay with taking risk, they would go to an ETF like ARK, and the companies that are underlying the ETF tend to do well because people are okay with taking extra risk. The economy's doing great. Sentiment is good. Sentiment is positive. But when sentiment turns, let's say, bad, or when there's a recession, or if there's some problems with the economy and there's a risk off type of market sentiment going on, then ARK is not going to likely perform as well because people are not okay with buying very expensive companies that you pay a lot of money for their earnings, or companies that don't make any earnings, because in times of economic trouble, those stocks might have a hard time actually succeeding. So people maybe take a little less risk with those stocks. So when it comes to ARK, you need to understand that it's possible that during times of recession, times of risk-off nature of a market, then it may not perform as well. And so you have to determine yourself if you're okay with that risk. It's not going to be the case that at all points in time, ARK is going to have 60% returns. It just can't happen. There has to be times when ARK's underlying investments, due to what they're invested in, will have bad periods of time. All right, now it's time to tell you about my thesis about ARK. So here's what I think. So the way I think of ETFs sometimes is that my personal portfolio should have some weight in ETFs or in sectors that I don't feel comfortable analyzing. An example of this is that I don't feel comfortable figuring out how much a bank should be worth or an insurance company. I'm not that good at figuring companies like that out. So maybe I would own an ETF that invests in the financial services sector or something like that, because I myself don't feel confident in finding those specific stocks, but maybe I think that that sector or the industry is worth investing in. And so if we think of disruptive companies as their own kind of industry or sector or part of the market, then in that case, I would say that I do not feel comfortable investing in disruptive technologies. I don't think I can figure out what a disruptive technology is, how much to pay for it, what its future would be. And so in that case, maybe I would think that ARK might be a thing that would hold a place in my portfolio. So if you ask me how much money I should put in ARK, then in my portfolio, I wouldn't have a very high percentage of my portfolio in this ETF. So ARK would maybe be a part of my portfolio. So for example, let's say I had 10 or 20 stocks. Well, ARK might be an additional position that I would put into my portfolio. Maybe a 5% position or so of my overall portfolio, I'd be okay to put into ARK. Now at the same time, I'd want to be okay with taking that potential extra risk if something happens to the economy and ARK doesn't do a great job performing in that period of time. So my conclusion is, at the end of the day, I think ARK is okay to add to my portfolio. I think I'd be okay having a position that's no more than 10% for sure, probably closer to a 5% weighting of my overall portfolio. Okay everyone, that is all we have for today. Thanks so much for watching, and let me know in the comments because I want to hear from you. Are you investing in ARK? Are you investing in ARKK, the ETF, a different ETF that they have? How much you gonna put in? What type of weighting from your portfolio gonna use? Let me know. Now before we go, since you've watched this whole video, hit that like button and subscribe if you wanna see future content that's like this. So thanks again everyone so much for watching, and please watch another one of my videos on the end screen by clicking it right now.